Sitting in EDSA gridlock checking your portfolio, you are unaware a homegrown Philippine company is moving millions of tons of cargo across the open ocean. This chart shows their full-year financial results for 2025. This was the year they crossed the $1 billion mark in net income, reaching a record $1.05 billion. That momentum is only increasing. In the first quarter of 2026, recurring net income surged 29% to $308.27 million. International Container Terminal Services, or ICTSI, has built a specialized network that captures trade revenue far from Philippine shores, generating massive wealth while most local investors are looking the other way. Enrique Razon Jr. is the architect behind this aggressive acquisition strategy. He has pushed the company into 6 continents, scaling a portfolio of global terminals that is no longer limited by domestic borders. The primary theater for their newest expansion is South America, specifically the sprawling coastline in Brazil. By integrating the Rio port with inland rail, ICTSI aims to control the movement of goods through the country's industrial heartland. This strategy is designed to link sea and rail freight into a single high-margin system, setting the stage for significant long-term profitability. This approach is called hinterland integration. It allows a port operator to capture revenue deep inland, hundreds of miles away from the water. The strategy began at the water. In 2019, ICTSI spent 10 billion pesos to acquire the Libra Terminal in Rio de Janeiro, thereby securing a critical maritime entry point. In 2026, they moved further inland, buying CRAGEA in Sao Paulo to capture its warehousing and rail networks. Linking the ocean terminal to this railway bypasses Brazil's congested roads, giving ICTSI an end-to-end grip on this supply chain. Prioritizing rail increases energy efficiency and clears historical bottlenecks, moving goods faster and more reliably. By owning the inland network, ICTSI locks in steady service revenues, insulating the company from the volatility of global ocean shipping rates. We can see the immediate impact of this strategy in the 2026 first quarter results. This chart tracks global container volume. Throughput spiked 18%, hitting 4.08 million 20-foot equivalent units. But look at actual cash. Revenue surged 29%, reaching $961.11 million in just 3 months. Revenue is outpacing volume because of operational multipliers, tariff adjustments, a better container mix, and fees from those newly integrated inland services. They aren't just moving more boxes, they are extracting significantly more cash from every single container they handle. For an investor, top-line revenue is only part of the story. We have to look at how much of that cash the company actually keeps. This chart isolates EBITDA. Despite the costs of massive global expansion, this metric improved 26% to $617.87 million in the first quarter. Operating highly profitable terminals across 6 continents creates a geographic moat. This global portfolio insulates the company. When the Brazilian real or Mexican peso depreciates, terminals in other regions keep the total balance sheet stable. ICTSI relies on a globally insulated system of capital allocation and cost discipline. This framework protects their margins in a way that purely physical assets cannot. This brings the focus back to the Philippine Stock Exchange. Given the 2026 momentum, the question for local investors is whether this growth is already priced in or if the stock is nearing a breakout. Is this strategy enough to propel ICTSI to become the next trillion peso company in the Philippines? We want to hear your analysis. Is this a buy, hold, or sell for you? Some of the world's most aggressive global port operations are currently being managed right in your own backyard.